Beyond the noise of Wall Street and the jagged lines of stock charts, there exists a legend. It's one that makes serious economists roll their eyes, yet endlessly fascinates countless investors and sports fans. Its prophecy isn't based on price-to-earnings ratios or Federal Reserve decisions, but on the simple outcome of a football game. This is the Super Bowl indicator. The seemingly absurd theory states that if a team from the National Football Conference wins the Super Bowl, the stock market will rise that year. If a team from the American Football Conference wins, the market will fall. For a remarkably long time, its accuracy was, as many noted, too good to ignore. The story begins in 1978. Leonard Coppett, a sports writer for The New York Times, half-jokingly made the observation. Reviewing the data, he found that for the previous 11 years and the following 12, this simple rule, based on the winning team's conference, perfectly predicted the market's direction. The early record was legendary. It correctly called 15 of the first 16 Super Bowls, a success rate over 94%. By 1997, it had an astonishing 28 correct predictions out of 31. For many investors, it stopped being a joke and started looking like a tantalizing financial oracle. The media ate it up, Wall Street analysts added it to their cocktail party chatter, and a national phenomenon was born. The indicator's appeal lay in its seemingly consistent hits. For instance, when the Pittsburgh Steelers won in 2009, the U.S. stock market did indeed climb out of the financial crisis abyss and begin a historic bull run. Conversely, after the New England Patriots beat the St. Louis Rams in 2002, the market took a significant dive. Time and again, these coincidences cloaked the theory in an aura of mystique and credibility. True believers even developed more refined sub-indicators. One claimed that if the Super Bowl's total points scored exceeded 46, the average market return was a whopping 16.3%. Under 46 points, it was a mere 7.2%. Whether the game was played west of the Mississippi River or under a retractable roof was thought to hold quirky correlations with market performance. However, any temple built on coincidence is destined to be a house of cards. To preserve the indicator's stunning accuracy, some laughable data adjustments began. The most famous involved the Pittsburgh Steelers. Originally an AFC team, its supporters conveniently reclassified it as NFC for the indicator's purposes because it kept winning in years the market rose, citing its roots in the old pre-merger NFL. Coppett himself later admitted that when the 1984 result contradicted the prediction, he did what any good statistician would do. He broadened the dataset, noting that among the NYSE composite, the Dow Jones and the S&P 500, one index would always fit the game's outcome. This cherry-picking of data laid bare the theory's fundamental weakness. Scientific scrutiny eventually cleared the fog. Yale statistics professor Gary Smith bluntly called the high accuracy a ludicrous coincidence, stemming simply from the stock market's long-term upward trend and the fact that NFC teams had won more often. In 1990, a paper in the prestigious Journal of Finance took the first serious academic look. While acknowledging its historical record, the authors clearly stated its predictive power cannot be ensured to continue, and the theoretical relationship is not apparent. The final verdict came in 2017. A follow-up study's title was as sharp as a knife. The Super Bowl Stock Market Predictor. A legend in the making. The data delivered a cold truth. From 1990 to 2023, after the indicator became widely known, its prediction rate was a mere 51%, essentially no better than a coin flip. The legendary model with over 90% accuracy had completely broken down in the real-world marathon. The Super Bowl indicator isn't unique. It's a classic example of humans blindly spotting patterns in randomness. Researchers have found the S&P 500's movements closely correlated with, of all things, butter production in Bangladesh. History is littered with similar indicators. The nationality of the Sports Illustrated swimsuit cover model was used to forecast the market. The hemline index suggested skirt lengths moved with the economy. Even a Rocky movie indicator claimed stocks rose when films in that series were released. These stories spread because our brains are wired to hate chaos, desperate to weave reassuring narratives from randomness. Today, the Super Bowl remains a multi-billion-dollar spectacle of national entertainment, but its outcome has long shed its mystical power to forecast the market. What began as a joke poking fun at statistical fallacy accidentally morphed into a mass superstition, only to be returned to its roots by rigorous data, a timeless economics classroom lesson on correlation is not causation. It teaches us that in the world of investing, the greatest danger often isn't complex data, but simple, compelling, yet utterly illogical stories of accuracy. After all, if a football game could truly chart a path to wealth, Wall Street's most coveted hires wouldn't be economists, but elite NFL analysts.